Hi, welcome to part 3 of my course, How to Build Tax-Free Income in Retirement. Part 3 is titled, Why the Government Loves Your 401k or IRA. All right, let's start with a 401k. All right, let's say that you have a 401k that has $500,000 in it. Now, whenever we do analyses for our clients, we try to figure out what their contribution amount was into that 401k. And on average, what we have determined over 35 years is that the average is close to 50% of what the accumulated value is. So if you have a $500,000 IRA or 401k and you have a $250,000 contribution, how much of a tax deferral did you get on that contribution over your working life? Now, another thing that we have discovered in our years of doing these analyses is that the average tax rate for people who are working their entire lives before they reach retirement is roughly 20%. Okay, if we take 20% of this 500,000, that means that this person got a $50,000 tax deferral. Okay? Now, let's say that maybe someone did really well with their 401k, and instead of it being worth 500,000, let's say it's worth $1 million when they reach retirement. Okay? Now, when they reach retirement and they redeem, they surrender their 401k, they cash it out to go buy a beach house, go buy a motorhome, whatever it is that they choose to do, they're going to have to pay tax on that money, correct? Now, the highest tax rate today, as we covered in the last part, is 37%. Some states, of course, have taxes as well. So if we take an average of 40%, you can say that the tax due on $1 million IRA is going to be roughly $400,000. Now, if you contributed $250,000 and it's worth $1 million, you got a 4-to-1 return on your money. If the government gave you a $50,000 deferral or postponement of those taxes, and you ended up having to pay $400,000 when you surrendered your 401k to go buy that dream home, the government got an 8-to-1 return on their investment in you. What if the IRA did really well or the 401k did really well? Maybe you had some stock options in there that you exercised and they really took off. And let's say the value of your 401k is $2 million. Well, again, you surrender it to go buy the beach house, 40% in taxes means you have a tax bill of $800,000. Now, your $250,000 became 2 million. You did really well. You made 8-1 on your money. The government gave you a $50,000 deferral so that you could postpone the taxes due and pay $800,000. The government had a 16-1 return on your money. No matter how far we take this out, however well you do in your 401k and IRA, the government will always outperform you. Let me give you another example or problem. Let's say that this 401k in the middle that's worth $1 million. As we discussed in the last part, the average advisory fee on a 401k is little over 1%. So 1% of that million, as we know, is $10,000. And that's payable every year that balance is $1 million. It's always going to be 1% of that number, whatever it is. If you decided to go buy that beach house and you paid the $400,000 in taxes, you ended up with actually $600,000 in spending power, right? That's after tax. How much of this advisory fee did the government pay? Nothing. They were a silent partner in your 401k, a silent partner that allowed you to pay all the fees. So you didn't pay 1% on $1 million. You paid 1% on your share after the government took its share. 1% of $600,000. So you didn't pay 1%. You paid 1.67% in fees. How does that make you feel about your 401k? How does that make you feel about the government's role in your 401k? This is why the government loves your 401k and your IRA. Tune in next. Part 4, we'll talk about how money is taxed in retirement. Thank you.